Hey, hope you're all doing well out there. This is your April market review. So for those of you that haven't seen these videos before, the reason that I put these videos together each month is to give my clients the straightforward information about what's going on in the market and the economy with no sort of political angle or fear tactics that many media outlets use to get more viewers to watch their shows. Doing this in a little bit of a different place today. So if you've watched these before, I have a different backdrop just because I'm in a different room. Same good material that I'm going to be giving you. The month of April was kind of a snoozer. The overall S&P 500 was about flat for the month. The year-to-date rate of return is still right around 7% for the year. Still a little bit below, or about 15% below the peak of the beginning of 2022, but definitely off of its lows that we had back in October of 2022. So a few charts that I have here today that I'm going to talk more about. If you haven't watched these before, I use a lot of charts and graphs, so that way I feel that charts and graphs give viewers a better feel for what I'm talking about and something tangible to visualize other than me just talking about it. So a few charts that I have here are, I'm going to go into a little bit more detail about the markets and the economy and just some of the things that I'm thinking about and where we're at within the market right now. One of the first charts that I have here is a chart of insider buying and selling. So these are corporate executives that are the heads of major S&P 500 companies buying or selling their own stock of their company. So this would be like the CEO of Apple, Tim Cook, buying or selling shares of Apple, for instance. So the chart here shows there's always more sellers typically than buyers, just because this is the way that a lot of executives get paid, is through stock options, which then they end up selling so they can live their life. But one of the signs of a market being, or a stock specifically, being oversold is when you see a lot of insider buying, meaning that there are potentially more insiders that are buying that individual stock because they think it's undervalued, and they're corporate executives of that company, so they have a better finger on the pulse than just about anybody about how that company is really doing. So this chart showing here, going back through 2020, the big spike in 2020 was COVID, which for a lot of executives at that point, it was a great buying opportunity because the market was so extremely oversold. Again, we had that about a year ago when we were almost at parity at 1 on the insiders buyer to seller ratio. And then recently, as of about a month or so ago, we've had a big spike in insider buyers or insider buying happening, which is a good sign for the stock market, meaning that these executives think that they're putting their money to work, thinking that the stock is going to turn around. If more executives are doing that, that's a sign that they're feeling that the market or their specific stock has at least come to a closer bottom. So I thought this was an interesting chart just because there's a lot of charts, and I'll go over another one here that looks back in time, that there's a lot of different things that you can kind of look at, but really executives have a better idea of how their individual company is going. They don't control bigger market swings like what happened during COVID, but they also have a very good handle on what their company is doing, their profitability, their future earnings outlook, all those different things. So it's a good sign to see that executives are buying, because that means that it may be a great time for individuals to be buying or being more aggressive within portfolio. The next chart that I have, if you haven't been watching the news recently, the debt ceiling is something that's been in the news this past week. I'm shooting this May the 3rd, which is Wednesday. On Monday, Janet Yellen, who used to be the Fed chairwoman, is now the Secretary of Treasurer. She came out and said that if the debt ceiling isn't increased by Congress by the beginning of June, that there is a possibility of missing payments and defaulting on certain payments that need to be paid by the U.S. government. That would be a really bad thing for markets and the overall economy, because the U.S. debt, the Treasury bills and the Treasury bonds that are out there, and other debts that the U.S. government has, those are looked at as like a guarantee type of payment to those investors that have invested money in there. So if they default on any type of debt like that out there, or anything that's coming due, that's a really bad sign for the overall economy and could push us into a recession almost immediately if that were to happen. So likelihood, though, of the Congress not increasing the debt ceiling isn't super high. I'm sure that with the political environment that it'll take some time to get it done, but that wouldn't be surprising at all. In the interim, though, we likely may see a little bit of a drop off because of that, which this chart here I have up is a chart from 2011, 12 years ago, when the U.S. Debt was downgraded because it came close to defaulting in 2011, and they had run up against a debt ceiling similarly to how they are right now. So I'm bringing this chart up because that happened in August of 2011, and then the debt was then, credit agencies then downgraded the U.S. debt, which really is, just insignificant in the grand scheme of things. But I think that this could create a good opportunity if we do get a pullback for a big move higher, because then that would be a huge reset potentially if, for whatever reason this month, markets do pull back and they then increase the debt ceiling. This could be a great buying opportunity if we do get that pullback. The next chart and final chart that I do have here that I wanted to talk about was a 5-year chart looking backwards. So one of the reasons I don't think it will be as dramatic as what we saw in 2011 is because in 2011, that was a market drop of about like 20% in a relatively short period of time. And then it rebounded back, to end the year roughly about flat from where it had started. So what I think will happen with the markets right now is, because we've already come down so much because of the drop we had last year, and even with the rebound that we've had so far this year, I think that there's so much bad news potentially baked into the overall market price right now that we may slide down a few percentage points. But if we do get that debt ceiling increased by the end of the month, that's going to be a great sign and a big reason that markets may move higher. It also, likelihood is that the Federal Reserve is going to do their last interest rate increase here this month, and they've talked about taking a pause just because inflation has come down so much on a year-over-year basis from where it was just about a year ago at this point. So this chart, though, showing the 5-year look at it, going back through 2018 through now. If we're looking at the beginning of 2022, when we were at that peak, we dropped off a lot into October, where you can see the bottom of last year was, and then we've come off of that pretty significantly. So we're not quite back to the peak. We're not there, but we're also very far away from the bottom. We're in a nice interim spot right now where the market could fluctuate dramatically one way or the other if there's some bigger news event that isn't expected. But I think that from a big picture standpoint, that if we continually get good corporate earnings releases and outlooks for individual companies, like what's happened here over the last few weeks with companies like Microsoft coming out, along with Meta, the parent company of Facebook, coming out, Amazon, the same deal, coming out and reporting better than expected earnings or better than expected outlooks, I think that can be a very big driving force for stocks moving higher, especially the biggest thing being that if they do stop raising interest rates, that's a reason to be more aggressive or more optimistic about stocks moving higher, specifically because interest rates increases is definitely a headwind for the stock market. So those are the charts that I have this week. If you have any questions, don't hesitate to call, text, or email me. If you have friends, family, just someone you think that would be interested in having a conversation with me or benefit from having a conversation with me, please get them in touch with me. I'd be more than happy to have a conversation with them. I appreciate you all taking the time to check me out. Until next time.